What's up everyone, it's Karthik with MoneyVest. So I've got a whole data-packed video for you guys in this update, and shout out to both Frontstrat and Josh Brown from the Compound because they had an interview which was about an hour and a half long, so 90 minutes of Tom Lee and Josh Brown. I highly recommend you guys watch this video. It's going to be on the Compound channel, and all the charts that I'm sharing today are going to straight be from this video, so shout out to them and all credits goes to them here. And I'm going to really synthesize the video. Of course, if you don't want to watch 90 minutes, you can watch the 12-minute video here. I'm going to break down all the charts that were shared, which in my opinion were super important with regards to rate cuts, the state of the economy, the market drawdowns, the small caps, semiconductors, everything that was discussed, artificial intelligence, politics, China stimulus, everything discussed in those 90 minutes. So I'm going to share it in this video. A very quick update on the MoneyVest index. We are now sitting at 4.12. So that's the highest level since July of 2024. And again, market breadth continues to expand further as more and more stocks continue to trade higher, contributing to this all-time highs in the S&P 500. And the MoneyVest index, as we already know, coming up to some very extreme levels, now sitting in the sixth quadrant at the moment, getting back up to the same levels from back in July earlier this year in 2024. So first things first, a lot of shorts in China are now squeezed and they're also trapped at the same time. So if you read this catalyst, came out literally yesterday, quant hedge funds trapped in a massive short squeeze after the China glitch. In other words, after the significant amount of stimulus coming in from China with rate cuts and supporting their actual monetary policy and their overall economy, we're seeing a massive increase in ticker symbols like FXI or KWEB. So if you come over to KWEB, that's the China Internet ETF, you'll notice a massive move this month here, up a little bit over 32%. If you come over to the weekly time frame, again, up over 26%. It was consolidating sideways in this range, and then we had a huge momentum higher. We're coming up to that resistance at $35. And same thing happened with FXI, which is the iShares China large cap ETF as well, up over 18% this past week. In the last 1 month, up over 21%. So significant amount of momentum coming in and already starting to break out above this resistance for FXI. So if you come over to the short interest on where we are, we're at 61%. So that is a pretty significant number if you consider the amount of short interest. And you look at the last time we were at these levels was back in, towards the end of 2019, early 2020. We saw a nice little gain here in FXI. Again, over here, very high short interest. We saw a nice little rally over here for FXI as well. So every time we see those short coverings, of course, market tends to move higher for Chinese stocks. So this right here was a massive cover. This right here was also massive covering of those options. And eventually this number is also going to be coming down because as a lot of these short sellers are going to start to cover their positions, that's going to lead to more buying momentum, which could possibly lead more upside into Chinese stocks as well. So Tom Lee and Mark Newton and a lot of other strategists and investors and analysts seem to be very bullish in China overall, and seems to be a very strong breakout to the upside from a technical perspective as well. And we also witnessed the second largest days of inflows for FXI on a year-to-date basis. So September 25th, over $44 million of inflows coming into FXI. And the last time you saw that was back in January of 2024. That was just over $57 million. So again, significant outflows here, significant amount of outflows over here. And this was the second, again, largest daily inflow year-to-date for FXI. So a lot of momentum and bullishness over in China. And the cyclicals are highly levered to China recovery as well. So these are actually some of the sectors, that subsectors and sub-industries that Fundstrat highlighted are going to be very highly correlated with the momentum that's coming in for China. So copper prices tends to be very highly correlated, over 50%. Then we've got semiconductors, we got electronic equipment and instruments, electronic components, we got electronic manufacturing services, semiconductors, application software, data processing, specialty chemicals, and industrial machinery and supplies. So we're looking at commodities, we're looking at industrials, we're looking at technology, more specifics to semis, as well as industrials that have a lot of momentum as this China trade continues to play on, as we're seeing a lot of momentum to the upside and breakouts on a technical basis. Now, moving over to the Fed policy and monetary policy from the Federal Reserve. 125 basis points total rate cuts by the year end is what the market has been pricing in. And as we continue to see more rate cuts, this was a chart from Tom Lee and Fundstrat, sort of indicating what that's going to do to overall credit cards, auto loans, 5-year ARM rate, 30-year mortgage rate, and he's expecting more downside for overall interest rates as the Federal Reserve continues to cut rates, right? So that's going to be the sort of like the rollover effect of how the federal fund rate gets lowered, and that affects the overall interest rates and the borrowing cost over in other parts of the economy as well, from mortgages to housing to auto and to credit cards as well, to small business loans, student loans. Everything is going to come down. Jobless claims are falling, is also from the compound, continues to come down to 225,000. That's the 4-week moving average. U.S. initial jobless claims sitting at 218,000 as of the most recent print. Of course, we were at much higher 250,000 levels back in July, April, June, July. We did have a little bit of an acceleration in unemployment numbers, but we're now starting to revert back to lower levels. And there's a lot of detail shared in these charts as well, because Tom Lee and Josh Brown, they were both discussing the soft landing or the no landing scenario, the labor market in a lot of detail. And this right here was one of the charts that was also presented, which was very useful in my opinion, which essentially says, don't fight the Fed cut versus economic cycle and where we are. The Federal Reserve cut, which is a no landing scenario from the Federal Reserve. That's what they're trying to orchestrate. And this right here is going to be a Fed cut with a recession. As you know, that with a recession, of course, comes more downside, and the probabilities for markets to be higher is significantly less. We're talking 20, 30, 40%. And 3 months forward, 6 months forward, 9 months and 12 months forward, the average return is lower by anywhere from 2.5% to as much as 7.5%. Versus when we get a no landing or a soft landing scenario, the 3 month to 6 month forward returns are 100% higher by an average of 8 to 12%. So that again was what was highlighted there, that we've got 100% win rate. In other words, perfect score for when the Federal Reserve rate cuts have begun. When it's accompanied with a no landing, in other words, a soft landing or no recession, 3 months, 6 months out, we're up by average 8 to 12%, 100% of the times. And these were January of 71, October 84, October 87, June 89, July 95, September 98, and July 2019 as well. However, I think one of the things that we have to consider is what really constitutes as a no landing, because none of these instances, apart from the great inflation of the 1980s, we didn't really witness inflation as high as over 9-10%. So interest rates obviously were not as high as double digits or getting up to 7, 8, 9, 10%. So we were obviously working with a lower base of inflation. And so when inflation was relatively speaking lower, right? This is the second time really we've gotten up to over 9% for CPI in a very long time, because we've really witnessed a long period of lower inflation levels. So 1980s, you can argue, yes, well over 9, 10, 12%. 2022, we were well over 9% again. So those periods are more difficult to manage than compared to other periods as highlighted by Tom Lee here, right? So 1971, 95, 98, 2019, 1989. So a lot of those times we didn't really have inflation well over 9-10%. So yes, the Federal Reserve could cut rates while orchestrating a soft landing or a no landing scenario. But what's been the scenario when inflation was much, much higher, right? So a lot of these areas like 74, 80, 81, we got 2001, 2007, when the recession followed, of course, the probability is quite low. So really the discussion is that are we in this type of scenario, or are we going to be a little bit over here? So what is really going to happen with the economy? Are we experiencing some type of economic contraction, recession, or are we experiencing a no landing or a soft landing sort of environment? And this right here is record inflows in utilities, and market definitely continues to be very, very defensive, putting a lot of money to work into utilities. Utilities tends to be, more of a safety trade, as it's very defensive. It's a necessity for most people, for almost every household and business. They need utilities, right, to essentially live every day. And this is a very defensive trade overall. And so market's positioning is very defensive at the moment. Now, it's still risk on because we're seeing broad participation across the board among all sectors that are pushing higher. But since utilities is the one that's actually leading this market higher, it's the one that's up over 22-25% year to date. There definitely goes to show that market positioning is still in somewhat defensive parts of the market. And this is percentage of stocks within year-to-date return bucket. So I got 209 stocks right now in the S&P 500 that are up anywhere from 0 to as much as 20%. Then we got 121 stocks up over 20 to 40%. And really, there's only one company that is up 180 to as much as 200%. That's VST. And then CEG. These are two utility stocks, which are really the outliers in the utility ETF or utility sector in general that are pushing or skewing the overall returns to the upside. And of course, we got Palantir and NVIDIA up anywhere from 120 to as much as 140% right now. So that's really the distribution for how many stocks within the S&P 500 in terms of their year-to-date gain. And Walgreens, of course, down over 60 to 80% on a year-to-date basis. The alone stock that is down significantly that much on a year-to-date basis. Now, this right here was market participation. So in other words, the market breadth. And the average for this number is 63%. This is percentage of stocks trading above their 200 simple moving average on a daily basis. And right now we're sitting at 75.8%. Tom Lee mentioned this is a sign of a broadening market, meaning that there's market breadth. But Josh Brown also mentioned that the moment we get up to as much as 80%, 90%, I think it's going to be a little bit of an alarming signal because, again, that's going to be suggesting for an overbought, overheated market, which, of course, is going to eventually lead to some downside as it always have in the past. So those are some things to obviously consider. The higher we get up to eventually, I think that's going to lead to a little bit of a pullback or a correction in the markets as well. So this rally is going to potentially continue. We may consolidate sideways, even trickle up a little bit over 80%, but eventually we all know we have to be ready for that eventual pullback or that correction. Now, switching gears over to the Russell 2000 and small caps. This right here is the percentage difference between the 5-year annualized rate of returns between S&P 500 and the Russell 2000. And this differential here is between 14% and 8.2, so a little bit over 5.5, closer to 6% differential there, so 5.7% to be precise. And whenever this number drops down to over 5 to as much as 10%, something that we have witnessed back in 1985, 1990s, and then the second time we saw that was back in 1995 and going into as much as the dot-com bubble. So this differential dropped to over 5 to as much as 10%. What happened was eventually we had significant outperformance in the Russell 2000 versus the S&P 500. So it's really just this pattern right here when it flips to a positive differential between the performance of Russell versus S&P 500. So this right here is also a positive differential, and this is where we are right now. So this is what they're highlighting in their front strat research, is that small caps and Russell 2000 has a lot of potential over the long term as it continues to underperform. It's relatively a lot cheaper compared to the S&P 500, and it's growing at a faster rate. So small cap EPS faster growing versus the S&P 500, over 18.7% versus 11.4%, and again trading at lower multiples compared to the S&P 500. And finally, coming over to some market drawdowns. Market drawdowns overall in general have been fewer and more rare, as we have already discussed on the channel before. The yellow, or really the orange, is going to be the market drawdown of over 20% for the S&P 500. The dark blue is going to be 10%. The light blue is going to be 5%. So what you'll notice is that we're seeing fewer yellows, or really orange, however you want to see that color. We're seeing fewer of those numbers because the market tends to be sort of in that buy the dip zone, where every time we see a 5 to as much as a 10% correction, market tends to get bought up fairly quickly, and we don't really materialize into a over 20% sell-off. And this right here is another really interesting chart, goes over the positioning of the 32 global equity indices. So a lot of indices, including the US, China, Europe, India, all those indices. And this is a chart put together by Goldman Sachs. And this is a proportion of those indices that are down over 5% and proportion of those indices that are down over 10%. So back in August, so August 5th, the carry trade, the yen blow up, we had over 94% of equity indices. So whatever that math comes out to, so 32 times 0.94, we're looking at a number that is around 30. So 30 of the 32 global indices were down over 5 to as much as 10% in that drawdown. So we had this number trading all the way up here, which was of course clearly a buying opportunity for the market. And right now we're sitting in the 20 to 30% range, meaning that whatever that 30 times 32 is, like nine indices are still down well over 10%, 5 to 10% from their all-time highs. So, of course, whenever we get a blow up on this particular chart, that means buying opportunity, because global indices across the board, 32 of them, are going to be down significantly from its all-time highs, 5 to as much as 10%. This right here was another really interesting chart going over the bull markets that have been longer since 1990s. So this is going over to the number of years those bull markets have lasted for. Years since the last 20% drawdown. So you can see that dark blue is significantly higher in more recent times. We've gotten up to 12, as much as 13 years. This right here over 9 to 10 years. This right here 5 to 6 years. And more recently, it's been a little bit more around 1 to 2 years. In other words, 2 years at most. We go through 2 years before seeing a 10 to as much as 20% pullback in the market. So, the long-term average I would put down is around 3 to 4 years, excuse me. So that's going to be that level, with some anomalies, of course, coming in 1992 all the way through 2000. We saw significant, rallies, and the markets went in much, much longer, several years, in fact, decades, before saw a 20% correction or a bear market. And this right here was back in 2012 all the way through 2016, 2018, and then finally correcting over 20% from its all-time highs. And then finally, this right here has also got a perfect hit rate, which is buy the dip on a 10% pullback strategy, and it's got a hit rate of perfect almost 100%. So that's going to be the hit ratio by 10%, and it's pretty much at 100% right now, which is also goes to show that there's been a lot of momentum for the markets. This is since 2010. Every 10% dip that you've bought, you've been up on over the long term, right? So 5 years out, you've had a 100% hit rate. And we've done something very similar. We've done a rolling analysis on a 15-year basis as well. And that's also yielded a perfect record of over 100%. Just goes to show that there is significant opportunity to continue to dollar cost average into the market. And a 10 and a 20% pullback or a correction or a bear market in the S&P 500 always leads to buying opportunities, because those are rare events altogether, and markets are trading at a bit of a discount. This was also a very, very useful chart. This is the percentage of allocation or weight of the S&P 500 within semiconductors, and it's now sitting at 10.7%. We were much higher at over 12.6%, but of course we've come down since the semiconductor stocks have pulled back, but they were at 1.5 to as much as 6%. Just goes to show how quickly we have doubled in that weighting, and this was back in 2022. So since in the last 2 years, that weighting of the semiconductor stocks within the S&P 500 has more than doubled here, going to over 12.6, then of course coming down to 10.7. And this right here is S&P 500 semi percentage of total S&P net income is hitting new all-time highs as well. So that's at 7.5%. So in other words, total semiconductor net income contributes about 7.5% to S&P 500's net income, which of course has come up from 2 to 3%, which also has been a significant increase on the back of this artificial intelligence boom. And then finally, we come over to this chart, which goes over that technology becomes a potential 50% of the S&P 500 weight. I mean, this is just going to be ridiculous at this point. Right now, as you know, from our MoneyVest platform, if you come over to our market concentration chart, you'll notice that the big tech, or Max 7, so to speak, makes up for about 31% of the S&P 500, but Tom Lee's putting up a case that can increase to over 50% because of the labor shortages that we're witnessing, and tech tends to go parabolic during those times because of the substantial investment that they do in technology. So the outperformance of technology during periods of labor shortages is substantial, and we believe the forecasted 2015 to 2047 to benefit technology stocks over the long term as well. So this is really a very, very long-term, ultra long-term call that technology is going to make up for almost 50% of the S&P 500. So there you have it. That was the entire breakdown of everything discussed during that 90-minute interview, synthesized and summarized in under 20 minutes. So hope you all enjoyed this video. The bottom line is, of course, we still have a lot of debate going around whether the U.S. economy is in a recession or not. But from a technical perspective, I think it's really important to remember that market positioning is still a bit more defensive. MoneyVest index is back above 4.18, almost at 4.2. Volatility did get a bit of a spike of over 10% last Friday. So I'm going to be cautious selling options to raise more cash and be ready to pick up some very sweet deals, good deals, if the markets does end up pulling back or seeing a bit of a correction moving forward. So always make sure that you drop a like, subscribe, share this video with your friends and family, other traders and investors. As always, happy investing. I'll see you all in the next video.